Okay, welcome back, everybody, to the Today's Market Explained. It's a 4-star media event, and we do interviews with important players in the financial world. We also do market commentaries. Today, we're going to do an interview, and this is really an interesting one. We have CJ Follini with us. CJ, welcome to Today's Market Explained.
Hi, Brian. Thank you for having me.
My pleasure. And CJ is coming at us today to discuss investing in private investments, but a training program to help people understand what it's all about, which is something we haven't heard before. So 4-star does a lot of alternative investing, but with our wealthy clients, the advisors inform their clients. This is a completely different process, and CJ is here to tell us about it. So CJ, tell us a little bit about your background first, and then let's hear how you got into training folks about private investing.
Sure. I was going to say when you were doing the intro that you do interviews with important players. I was also going to say, and also CJ.
Oh, okay.
From that very nice little group.
Okay.
But
you're certainly down.
Yeah, well, thank you. That's very kind. I fished for that compliment, so I fished hard.
You got it.
Let's see. I started a long time ago. My story starts with me as a failed professional hockey player whose father had a stroke, and he was a large builder and contractor in New York City, where I born and raised. And in my teens, late teens, 18, 19, he had a stroke, very serious one. And I could say there were a lot of sharks in the water, and I mean human sharks. So the message was, give up that career that's not going anywhere anyway, CJ, and you're going to come back and figure this out. This is 87. Now, 87 is pre-internet. It was certainly pre-online learning. It was pre-accessible alternative investment. It was pre a lot of things. And what happened was I had no mentors. I had no asynchronous online learning to help me with something that was very practical. How do I protect my immediate family and advance all of the alternative investment portfolio that we were very heavily allocated to, never having done it before, not knowing anything about it? How do I do this? Who can help me? Where do I learn? I had zilch on the answer to all those questions. Luckily, I survived, made every single mistake in the book, got out the other end, and actually figured out that I was pretty good at alternative investments, private investments, in multiple asset classes. And that success, coincidental though it may have been, that success brought referral and other families. And then not only was I managing our immediate family while even after my father recovered from his stroke, partially recovered, but we brought other families, joined what was more or less a de facto multifamily office. We preferred to call it a co-investment syndicate. And it at its largest 5 years ago was 9 ultra high net worth families and $1 billion assets under management. That's what I did for going on 30 plus years. The beginning was rough, and then again I figured it out, and luckily I survived. Some people don't. We're building something for that 19-year-old CJ, but the one who's now. The millennials, and it's about the great wealth transfer. Millennials and Gen Z are going to inherit $5 trillion in 2 years, Brian.
$5 trillion. That's right.
And yes, millennials specifically. And then if you go out 15 years, that number goes up to 40. And then if you go out 20, 21, I believe, and you add in Gen Alpha, you are looking at $72 trillion. This has never happened in the history of our planet, let alone the history of our country. Unprecedented.
Wow.
So I said to myself, and by the way, COVID was a huge transition for us. I had been doing the same thing for 30 years. I now have 2 kids under 3. And I said to myself, walking on the beach during COVID, I said, what is my legacy? I've been pretty good at what I did. I had 23%, IRR track record, in multiple asset classes. What am I going to show my kids? A track record? A number? What was the build? What am I leaving? And then as I started, and coincidentally, this whole great wealth transfer research really started to hit me. And I said, That's it. I'm doing fine. I'm fine for a lot of lifetimes, right? I'm fine. The people I invested in, they were fine before they ever met CJ. They did a lot better with me.
Yeah.
They were fine for. So I was, what's the real impact? I said, let's take all the mistakes I made, the learning from all the mistakes I made, everything I learned, and pass it on to the next generation. So bad mistakes and tragedies don't happen once this wealth transfers from baby boomer and Gen X, my generation, to millennial and Gen Z.
Right. Interesting. Well, good. So you're seeing this big wealth transfer, and you're involved in, you're working with all these families. So then where do you take it from there?
Well, that's a very good question. I think that I'm not sure there is a from there because it's such a massive undertaking. You know, I like big, hairy goals, and I really don't think there's an end. I don't think there's an end in my lifetime. Really, I mean that. And again, what I did what I noticed and observed is that you cannot be a specialist. You cannot be fragmented. You have to be a holistic experience of education, mentorship, peer-to-peer interaction with live events, and the access to alternative investments, what you do and what Four-Star does. So we actually started, we didn't talk about this in the preamble, Brian, but we actually started with the alternative investment access. We have 5 private placements that we sponsored. We're not going to sponsor more because in essence, we built 6 companies, but those 5 private placements are in the asset classes that have been my personal core strength for a long time: commercial real estate, diversified logistics, commercial real estate, private credit, fine art collectibles, consumer packaged goods, brands, right? Investing in brands, and private equity. So those were the asset classes that we trafficked in for a long time. And we started those.
Great.
And I was going to say, we raised $105 million for the first 2, which was commercial real estate, diversified logistics, called NOYACK Logistics, and then $4.5 million for NOYACK Fine Art.
Okay. Very good. So you were in the fundraising business, but you made a shift though now to not just being in that business, but in more of the education business. So let's talk a little bit about that.
Well, yes, we raise funds, but we're not fundraising, and I'll explain. I think that everyone historically, sales, fundraising, I've always had a problem with it, even when I was on the receiving end of it, and I have been for a long time. I had every major alt in my office asking to allocate from our syndicate that I was the CIO of, BRE, Aries, Blue Owl, Fortress, them all. And I'll ask some very basic, all the top 41, there's 41, even Harrison Street on a little bit smaller side. And it was always about, this is why you should transact. It was always about, let's transact, let's do a deal. Now, I love deals. I love talking deals. But I did recognize that there were some inherent problems with leading a relationship or starting a relationship with a transactional conversation. Mm-hmm. I always believe that these fundraising should start with information and education offer. So our funds raised comes from what we're building in the education, mentorship, and research areas. We focus on those. We build a club. We let everyone in the club inclusively, right? It's a walled garden, but it's a very, very big one. And then we say, when you're ready, and if you may never be ready, but when you're ready, if you want to speak specifically to another sponsor of a private placement, another asset class that we don't sponsor, or us, let us know. And if you don't, enjoy the club, enjoy the live event, enjoy the research, and so on.
Okay. So, but again, that's taken some different turns now, and you've got a whole new program to train people who would not normally be the people who would be involved in this segment, right? That's what we were talking about earlier.
Yes.
Good. Well, So let's take it to that level now. What is your operation doing now?
We're building the NOYACK. It's a NOYACK club. We just hope we are NOYACK, and more or less, it's a NOYACK investing club where we teach 21 to 39-year-olds about personal wealth management, specifically about the private investment universe as a key component of that personal wealth management. David Swensen, the same CIO of the Yale Endowment, had his mantra of getting to 30. He was a zealot of modern portfolio theory. So are we. My 9 immigrant families, just like my own, we were way beyond 30% allocation to alts and private investment. In fact, we were more adherents to the postmodern portfolio theory. Well, it is proven right now, the survey data is that millennials are already allocated 18%, right now, 18% on average to alternative investments. My old ass generation, Generation X, and Brian, I'm not going to make guesses on your age, but I'm 6% in my generation, 6. So we are already in a generational shift 3 times the Gen X average allocation to alts. And guess what? Gen Z will get to that David Swensen magical 30%. They will. Still, if they're getting all this money from the great wealth transfer, they love private investments, they don't inherently trust the public markets, how are they going to do what they want to do and do it successfully? Right. That is the answer. That is the question that NOYACK answers all the time. Let us give you the tools, the peer community, the education. I mentioned to you before, we have basically a digital campus. So you sign up for the club and you enter your digital campus and you can decide, I want to go to a couple live events. I need some research about specific alternative investment offerings. I have B reading in my office and they want my money, 32-year-old, because I'm a hotshot lawyer at Skadden Arps. Actually, Skadden Arps isn't big anymore. I don't know. Paul Weiss is very big.
They were.
Paul Weiss. Sure. Yeah. Once upon a time, it was Skadden Arps. Now it's Paul Weiss. And they're asking me questions that I don't know how to answer them. And I don't know if I should do it other than, a friend at a party or someone on TikTok, which we all know how
that goes.
Successful that is, where that goes. Exactly.
Right. Great. So, great. So tell me then, with the specific program of 21 to 39-year-olds, more about this process. It's much more educational and give us a little bit more detail about that and then how people can get involved.
Sure. Well, again, it's very simple. You go to wearenoyack.com. That's it. That's my shameless plug. Wearenoyack.com. You sign up. It is free for the first 6 months, because if you're not getting 4 times the value, then, and what's 4 0? It's a 0 actually, but there is a very small price per year, but we're giving 6 months free in order to build a community that feels valued. And I don't think asking for $1 when you first meet is the right way. That's what I meant by the transactional nature of fundraising and alternative investments. Currently, you shouldn't ask for dollars when you meet someone. You should say, how can I help you? So that's what we're trying to do. Wearenoyack.com, join the club. You can go into our digital campus. There's a 22 modular learning academy. We call it NOYACK Academy. It is specific to the private investment universe, but there will be estate planning. There's a lot of products being launched. Estate planning, tax planning, trust, your generational wealth transfer ideas and education, like a 529 and how to use that interactively with the new Roth and IRA, the 401k and Roth IRA programs that are coming down the pipe. So that great wealth transfer starts with the transfer. So that digital campus gives everyone the tools they need in order to get a good head start in personal wealth management.
Mm-hmm. So it sounds like a much more comprehensive approach. And you mentioned David Swensen and the guidelines of 30% and alts, and maybe perhaps no more, but your group had gone way beyond it, and many investors have been way below it. I can remember generations before mine did no alternative investment. They didn't even know what they were. And so
even if you did, you couldn't access them. You could not access them. They were inaccessible for most. They were
Right.
almost exclusively institutional at one point.
Right. And now we're democratizing that through different means, and certainly you're a leader in that. So can you maybe guess or tell me your thoughts as to why was this all happening? Why are the younger generations getting involved? Do they not trust the stock market, or they just have more access?
They do not.
What? Yeah.
No, I can give you the data points. So we've actually engaged in, I want to say, 18 months of study, looked at every research. I bank with Bank of America personally, and so did our former family office. So we have access to all of their research. They use Cerulli & Associates. It's an outstanding macro research firm in Boston. And so I've read almost everything there is to know about the Great Wealth Transfer. And here's what I learned that I actually given a keynote speech. I gave it to the Global FinTech Conference not too long ago. 1, 21 to 39-year-olds, I'll just say millennials, Gen Z, as a cohort, do not trust the public markets. 2, they don't trust their parents' advisors. That's really bad news for the RIA industry, because right now, the retention rate of an RIA intergeneration, by the way, I'm speaking domestically, so all of this research is domestic US. Should have said that up front. That doesn't mean it's not going to happen throughout the world. My research was specific to the US, but it is going to happen in every country, a little bit culturally different. But in this, so what I was getting at, so intergenerationally, the retention rate of registered investment advisors, when they pass the next generation, 13%. How is that future looking good if your industry is only retaining 13% of their passing of their existing clientele? That's bad. And then the surveys also show that over 60% of this inherited cohort of massive wealth get their information and education from, and I quote, a friend at a party, TikTok, or I'll just use TikTok for all social media, and I don't know. I don't know was the biggest one. So 61% is they're all going to inherit massive wealth. They have no idea what to do with it. For me, that is that's a country liability, not just for them specifically, huge liability for them, but that's a potential domestic catastrophe in what could happen with this lack of practical education in personal wealth management. So there is a lot of data there, and the conversation is not really crystallizing in the way I thought it should. We're talking, again, that's the market of $5 trillion in just 2 years.
Very interesting. Well, and so this is a great service. Do you think that the rise of alternatives among the younger set has something to do with the startup culture as well that's developed? There's incubators in every state now, and a lot of startup companies. Yeah. Okay. Tell us about that.
Very much. That's an interesting point. I actually haven't heard it I haven't heard that point in that question phrased in that way. But I was thinking about that recently. Listen, the last 12 quarters in this country have seen the greatest growth of SMB, small to medium-sized small business in the history of this country. And every quarter, year-over-year growth. Quarter-over-quarter growth. And a lot of those are so small that they're solopreneurs. And of course, if you are on LinkedIn for any 5 minutes, you're going to see the word solopreneur. Entrepreneur, definitely, but also solopreneur. So everyone is advocating this DIY mentality in creating business. And I think the rise of venture capital over the last 25 years was the fire. That was what lit the match. The rise of VC and the actual crowning of startup founders. They were kings. Elon Musk, Zuckerberg, not so much anymore. They're not looked at the same way. They're brand. But once upon a time, last 20 years, these startup founders were big celebrities. Elon Musk, you can still argue it as a celebrity right now. So all of these things have played into the generations that they're now being inculcated with the media that if you want to make it, really make it, you got to do it for yourself, not go be part of a cog in a giant wheel. And that has taken hold in these generations, very much. Listen, I am not going to advocate what Kevin O'Leary says on LinkedIn. I think it's blathered, but his point is he's tapping into a mainstream of conversation. That's what clickbait is about, okay? And that mainstream conversation is about entrepreneurship and even specifically solopreneurship. Do it yourself, be a content creator, build a small business of one. And that's both good, and there's some bad to it, which we'll leave for another podcast. But that's the movement. And for millennials and Gen Z, that's where it's going. They want to be in control. They want to be in control. That's really what solopreneurship and entrepreneurship is about. And when you're an RIA and you see that retention rate and you see a mentality that wants to be in control, I think you better start figuring out how to speak to this group pretty darn quick and in a different way.
Yes. Well, and the big talk in the last decade or so has been all about cryptocurrencies, which is a form of alternative, however you want to slice it and dice it. How would that fit into any of the discussions that you're having? And what kinds of things do you talk about relating to crypto?
Oof. That's Brian, that's once upon a time, that was the abortion issue for a politician. You bring up crypto to a traditional alts and wealth manager like myself, or one I used to be traditional. Okay, and it's a big topic too. So let me see if I can condense this. First of all, digital assets is something we speak about. It exists. It's important. It has grabbed the attention, probably a predominant amount of attention from the cohorts, from the demographics I'm talking about. So definitely a topic that absolutely needs to be addressed and considered. That's the issue. For example, I think that as a toolkit framework, it is going to revolutionize digital authentication. It's going to revolutionize authentication. It's going to revolutionize the recordation of ownership, just like a title. Once upon a time, there was no deed ownership of real estate or a title or title companies, right? And then there were. Fractionalizing your car and representing that with an embedded smart contract on chain. Imagine that. So, do I see it as a store of value? That's where I start to diverge from the conversation, and that's where I get a lot of pitchforks thrown at me. I do not see a lot of digital assets as stores of value. That is my opinion. That is what my research tells me. I'm going to get attacked for that over and over. But as a means of underpinning the entire asset economy, it will be game changing on the positive.
So why do you think it's not a store of value?
I think stores of value have to have an intrinsic use case beyond finding someone who thinks it's worth more than you do.
Okay.
An intrinsic use case is shelter. An intrinsic use case is transportation. An intrinsic use case is clothing myself so I don't physically have pain. Mm-hmm. Entertaining myself so I don't become a depressed monomaniac. Right? Entertainment, right, as a real use case. So my point is that if I cannot identify an intrinsic use case, and it all depends on, forgive me for this, but I do believe this, and this is only, I don't monger another thing, but greater soul theory, I do believe, I don't want to say fool. It's just that when something only has value in a relative, subjective way to two different people on the opposite side of a trade without any intrinsic use case in the middle, that's where I have a problem, and that's why I don't.
Okay, well, that's interesting. Well, it's not beyond crypto to develop a intrinsic use case over time. It's just a matter of
I think there is one right now, Brian. I think
it's possible right
now.
Okay, what do you think?
The original use case, hold on. The original use case was money laundering. We all know, if anyone doesn't think that's the original use case, then you should learn to come to our NOYACK Academy and you'll learn a lot better. But now that use case has really been eliminated, rightfully so, there is a use case. The use case is to decentralize the authentication of asset ownership, make it transparent. When we're talking about alternative investments, right? A lot of them are not transparent. The ownership of them are not transparent. The cap tables, ask BREIT for their cap table, see what you get. See if you even get a call back. You won't. So I think the use case is transparency. Transparency of asset ownership. Everyone should know who owns what and how much and why. That's another radical belief. And that comes from someone who's, look at my head, right? That's as legacy as it gets. All right.
Yeah. So, as you know, Forestar's done a lot of alternative investing. I've personally done a lot of angel investing, being an original member of the Hyde Park Angels there out of University of Chicago. And the angel metrics haven't changed over the entire time I've been involved. The returns are high. The variance in returns is also very high. Do you see any of that changing? Could that be why more people are getting involved, or is it just proximity to the product and culture changes that are causing this? Because we haven't seen any change in angel results over the last, they're high and very good, but we haven't seen a change in the last 50 years. What's your thought on that whole thought process?
Wow, you're really asking some big question stuff. Again, each one of these could be a whole podcast. Okay, so I've made 75 direct investments as a CIO family office. What was my track record? I think if you look generally, my track record was above average to good, pretty good. And then I look back and I say, relative to the absolute dollar value of all of that work and adding in the time and the due diligence and the portfolio management as a direct equity investor, and then relative to other asset classes. So when you put in the opportunity cost of time and effort, it did not come out very well. It does not. When you look at in an absolute black and white return, like a total return basis, it's great. And it also achieves a tail end return case with volatility, right? To mix in with more stabilized returns and more middle market returns and private equity. So it is absolutely a critical part of a diversified and risk diversified portfolio. However, it is one of the few places I think should not be democratized.
Okay.
Because I think the inherent risk of angel investing, which is why I do believe in grouping. Golden Seeds, I was a board member of Golden Seeds. I have a female founder thesis, again, another time, that really just had to do with the amount of flows of capital in and out of female founders, et cetera, et cetera. Hyde Park Angels. I agree with that shared risk mentality. I really do. Mm-hmm. And I sort of agree with the use of general partners as a means of doing venture equity investments, as long as the alignment, they have skin in the game, they have their own money invested, and their fees are reasonable and aligned with the investor, LP, right? I believe in that too. But I would say now that becoming a direct investor in venture equity, especially on the early stage for an individual, is not a good idea.
Okay. Well, and you know, since the metrics haven't changed, there are many aspects of alternative investing that are very distasteful, as you said, as well, where the variance in returns is very high. Some people can't get comfortable losing everything in a deal. A lot of issues like that. So maybe we'll see some of that play out as a lot of the people are being trained, learn to not like it, but maybe they will like it. But at least you're showing them the door. You're showing them the information that they need to make a decision, and we'll see how things play out.
That's the idea. I want to say one last thing. The first thing that I teach people about venture equity, especially early stage, is you cannot anticipate duration. Everything, of course, everything's about diversification. That's the first rule. But the second rule is diversifying many ways, diversifying across risk, diversifying across asset classes, diversifying across amounts, and diversifying across duration, time in the investment. Guess who didn't do that? SVB and Signature, SVB primarily. Complete risk management breakdown on one aspect, duration. How do you have an entire tail end majority in a long-term duration with zero diversification? So when I say to individuals on the personal management, if you're looking at venture, it's fun, it's exciting, it's all these things. But if you cannot estimate in any way the duration of your investment in this, then it's really a hobby for the individual, and it should be looked at that as that. Now, you can look at it as part of a portfolio through experts who have a better data set to give you an estimate of duration. We invested in this sector a couple hundred times. These are our return metrics and amounts, and this is our average hold. Okay. Mm-hmm. Based on that data sample, you can make an estimate. But if you're a direct LP, you're never going to have that.
Right. Well, they often say that track records don't mean much in alternatives because the circumstances keep changing so much and the variance is so high that it's hard to really quantify all that. But I understand.
Imagine 35-year-olds who have never experienced an interest rate environment over a 2% discount rate. Imagine all those who are now, when they're about 40. I was there in 87, and I remember my father hooking his fingers right before he had a stroke, weirdly, hooking his fingers in this and saying, look at that, National Westminster Bank, we have their best private lending rate for our warehouse line as a business. Their best rate, 9.5%. And he was proud. That's the last time we're in this environment. And that's 40 years. So people who have been in business for only 20, 25 years, they had no context of what is happening right now. In fact, getting back to venture equity, you're not competing with other VC. You're competing with the Treasury, with the Fed. You're competing with a 5% Treasury rate because people like, can I go into this VC fund or should I go to sleep at night and put my money in a 7-year, 5% T-bill? I think that's where I'm going to go.
Well, and that's true. We've seen that in various markets. When the long bond went over 10%, that was a month later, we had the crash of 87. So when a fixed rate goes high and they're going higher in the short run, the short rates, it creates competition for all the other riskier assets that are out there. And so that's really an issue right now. We'll see how that plays out over the next few months. I don't anticipate seeing 5% money markets forever. But certainly it's an issue right now.
I agree. By the way, great call out on 87. I remember Black October. I remember it. I was young, but I remember it.
I was there.
2001. Yeah. So that was an interesting time. And 2001, weirdly, was not an interest rate inflected venture crash. It wasn't. It was a liquidity. It was a deflationary liquidity crash. But both are something that people should maybe research when they're looking at today. I do believe I'm not going to be Jeremy Grantham and say the end is nigh. I'm not going to do that, and it's not. But I think what you brought up, two different very significant times, should be learned from.
Well, and you know, we don't operate in a vacuum in the investing world, whether it be private equity, private investing of any kind, or public market investing. Monetary factors definitely affect us in the aggregate sense between countries, within your country, and all those issues. So we have to be aware of that. But just understanding that there are generally better returns from alternative investing, and that's why people do it. What was the case that David Swenson made? Why would they do 30%?
Because you can't achieve. I mean, the real point was you cannot achieve true diversification from a 60-40 portfolio. That's what he said. I mean, that's the most succinct way of a very complex issue of again, modern portfolio theory, and then into postmodern portfolio theory. You need non-correlated investments. That's a big one instead of the 60-40. And you also need factors that are not driven by emotion. And a lot of the 60-40 is driven by emotion. How do people feel today? Are they feeling like buyers or sellers, right? You need things that are divorced from the human element. And a lot of alternatives do not allow you to make a decision when you're feeling like shit.
Well, yeah, that's right. That's right. Well, good. So what do you think will come out of all of this then, CJ? The training that you're doing of younger investors, their intensity about investing in private investing. Will that change the outlook of the investing world over the next couple decades?
Brian, if I could answer that, then I will invite you to my private island in a few years. But I can't.
Very well.
I would have a very Richard Branson would be envious of the island I would have if I could answer that question. I do think, in all seriousness, I think that what I'm talking about, and the idea of education and the great wealth transfer, supporting that is not a 2. It's not even a 5. It's really, I want to say, the earliest you're going to get an indication of the answer to your question, good question, earliest 7 to 10 years. And I'm not sure as a 56-year-old, I'm going to be spry enough to remember, hey, I got to call Brian. I got to give him that answer. Look at what I learned. 10 years, 66. Now I know. I think I know where it's going. And even that will be another 20 years of answers.
Yeah. Well, it's interesting. Well, we've seen, we've covered the subject of training and why that's important and why what you're doing is important for the industry. We've also since opened up so many other discussions here. We're going to have to do a follow-up, CJ, I think, because I think our time's coming to an end.
We didn't even talk about the future of education generally, Brian. I think that that last question, which I tried not to vector and digress from, I think opens up the door to discuss where is the future of education broadly, not just financial education or personal management education or alternative investment education. What is happening to education across the board? That's a great topic.
Well, maybe that'll be the topic for our next meeting. Then we'll have to kind of tee that one up, CJ, and discuss it. But beer can be involved in that. Absolutely, that's a
discussion. Great, thank you.
And but it is good to talk to you. It's impressive to see what you're doing as far as training and education. And how can folks get involved? People in that cohort that you're targeting, how could they get involved?
If you are a millennial and Gen Z, whether you're inheriting money or not, but you just want to learn how to protect your future and create generational wealth, please visit. And they actually trained me to do this. Please visit wearenoyack.com. That's wearenoyack.com. Join the club. And that comes with an academy, modular education, research, mentorship opportunities, as well as live events to learn from each other. It's not we're the lecturer and an all-being know-it-all and we're telling you the way it is. It's want to learn together, including ourselves, to win together. That's the idea.
It's a great idea. No problem. It's a great service. And, we do see a lot of investors work with thousands of families at 4-Star. We see an awful lot of, ready, aim, shoot, where people don't know what they're doing and they jump into areas of investment without any training. And maybe you can get by in a good stock market, but in the alternative world, you better be trained. You better know what you're doing, or you're going to make a lot of really, really dumb mistakes. And those mistakes are going to be big and they're going to hurt.
Last thing I want to say about that, about those years, I just not too long ago, a banker said, look at our track record, 2013 to 2019. I'm like, come on. Really?
Yeah.
Those are the years you chose? I think a donkey throwing a dart over its shoulder could have...
that was a bull market?
As well. Yeah, that's right, as well as anything. But your point is well taken, is that education is really needed when things change, and things are changing all the time now.
They really are. Well, great. Well, thanks for providing that, and thanks for your service, and folks can sign up with you and learn, and that's a great thing. And then certainly anybody who wants to talk with 4-Star and any of the advisors at our firm concerning any of these subjects is welcome. You can call us right at our home office number, 312-667-1750. You can ask for me, and we'll make sure that you get to an advisor, and we can connect you as well with CJ and his group. So I think we're going to leave it there, CJ. Thanks, everybody, for being with us today.
Thank you,
CJ, for being
Thank you, Brian, for having me.
Really appreciate it. And we'll be back again with another interview. We'll probably do a follow-up with CJ sometime soon and open up some new topics. And we'll go from there.